Retailers and consumers are navigating a volatile landscape with slowing economic growth, sticky inflation, and ongoing trade tensions testing their resilience. My next guest says this current environment has helped create a few winners and a few laggards. Joining us now is John Kernan, Managing Director and Senior Analyst at TD Cowen, who covers the retail and consumer sectors. John, welcome to the program.
Thanks for having me.
All right, we got a lot to dig in here. I want to start with those tariffs, still a main concern and source of uncertainty. How has the U.S. retail sector fared in this environment?
Yeah, tariffs created uncertainty for consumers, investors, CEOs, CFOs as we exited April. But we've not seen much inflation yet in discretionary retail, which is encouraging. The retail sector as a whole is now preparing for back to school and holiday. Those are the two most important earnings drivers of the year. Inventory levels are higher than they need to be in a few areas, but that's because some companies pulled forward inventory ahead of tariffs. I would characterize the demand environment across discretionary as solid, but not great. But really the biggest piece of uncertainty is the tariff impact on cost of goods sold for all our companies and the ability to pass that through with price. That'll be a big determinant of the winners and the laggards into holiday. And I think if you look at sector valuations now, they're back to 2025 highs, and they're above historical averages. So we are expressing some optimism here in the market.
Yeah, when you mention back to school, I think back to school sales, and I don't think about companies passing on tariff costs to the consumer. How is that a shake? I know as an analyst, we have to take a look at a company, then you have to sort of reconsider, and the analyst community out there about where they get their products from. Can they pass that price along to the consumer?
Yeah, I think a lot of the inventory that's in the marketplace now is sourced earlier in the year when slightly lower tariffs were in place, excluding China. So the biggest pieces of inflation you're going to see are going to be October through December and then into the first half of 2026. And we really haven't seen much of a tick up in CPI as it relates to a lot of the key discretionary categories yet. But we're watching those rates carefully, and do expect those rates to move higher as we get into October and beyond.
When we think about those companies that are getting their products from other countries, you said obviously a lot of buying was pulled forward. It'll be later this year. You start mentioning December, I start thinking about the holidays. At this point, is there clarity when we're looking at the retail sector as to which companies are the most exposed and others that perhaps are not as exposed?
For sure. We think the recent clarity in trade policy is a good thing for companies as we head into August 1st. That said, when most of the companies issued guidance, when they reported the first quarter 3 months ago, they were assuming lower tariff rates for their Southeast Asian sourcing bases than what we saw with the recent trade deals that were reached, most notably with Vietnam and Indonesia. We're also still waiting clarity on Cambodia and Bangladesh, which are huge sources of supply. So there's some clarity on the trade policy front, but not enough for companies to make definitive decisions. But we do expect companies to have to adjust their guidance for a higher tariff hit, particularly from Vietnam, Indonesia, and it could be a much higher hit for Cambodia and Bangladesh as we go into the back half of the year.
Now that's the companies, obviously the consumer has to show up to buy. That's the whole business. What is the mood of the U.S. consumer right now, given all this economic uncertainty, the tariffs?
Well, we're finding our companies with premium innovation and differentiation in the marketplace are expressing confidence in their outlooks for the fiscal year, regardless of the tariffs. But it's a bifurcated environment. There's others that are struggling. When you look at the broader consumer, it's been a bifurcated, choppy year so far. 2024 was a very strong year for the U.S. consumer, and we're in a much more moderate environment from a traffic and spending perspective broadly in 2025. With financial markets at all-time highs, the high-income consumer is on better footing than the lower-income consumer. The top 10% of income earners in the U.S. account for 50% of total PCE spend, so they're huge drivers of consumption. Those lower-income consumers, they've been much more strategic in their discretionary spending. We've seen much choppier results and inbound data on companies servicing lower-income consumers.
In a recent conversation I had on one of our other Money Talk shows, I had a guest basically saying that more budget-conscious, lower-income consumer threw in the towel a while ago, and now the well-heeled ones are maybe showing a bit of caution. Is that what we need to watch right now? What people who have a pretty solid bank accounts start to do in this environment?
Yeah, they're always a very important piece of the overall pie. If you look under the hood, you're seeing pockets of definitely weaker results among consumer-facing companies that have exposure to younger and lower-income consumers. When you look at the higher-income consumer, we have not seen that consumer crack yet. And they're certainly allocating discretionary dollars more carefully than they were in 2024. And that's created some volatility among our companies. But I still think the consumer broadly is in decent shape. We're obviously closely watching the unemployment numbers, the inflation numbers. So there's a lot of policy and macro data that's still coming down the pipe.
Heading into the fall, how do you see borrowing cost, interest rates, and Fed activity?
Yeah, we think the median outlook among the Fed committee for 2 rate cuts seems fair. We're in the camp that the Fed can and will cut rates into the fall into 2026 by roughly a total of 125 basis points. Over time, that should be a slight tailwind to the consumer, and if they can cut further as tariff inflation ebbs, you could see more than 125 basis points of cuts. Consumers benefit from lower rates and also lower inflation. Inflation has done quite a bit of damage psychologically to the consumer as it directly drives their own cost of capital for borrowing and their perception of value when they're using their discretionary dollars.
All right, so lots of big themes out there for us to think about in the consumer space. If we start looking at it from an investing standpoint, I understand you have a few stocks that are on your radar. Let's take them one at a time. Ralph Lauren, what are you seeing here?
Yeah, a lot of momentum in the business and the brand globally, both in North America, Europe, and Asia Pac, particularly China. They report results next week. We think they're in a position to potentially raise guidance. They're also having an investor day in September, which we think will lay out robust growth over the next 3 years into their fiscal 28. Now, the stock's trading near all-time highs. We've rated this stock a buy for a long time, and we continue to think that management team is executing incredibly well from a merchandising standpoint, marketing standpoint, executing their DTC strategy. I think there's a fair amount of margin expansion over the next 3 to 5 years that consensus is underestimating.
What would be the risk in a name like Ralph Lauren?
Yeah, trends can change, and they certainly have been on trend for the last several years, so the comparisons are getting harder. Their gross margins up over 1,000 basis points over the last 7 years. So that they have had success. They're going to lap that success with continued strong execution. But there's always a risk that the consumer can be fickle, particularly younger consumers. But again, we think they're well positioned in this environment, particularly versus peers.
All right, this next name I'm not as familiar with, Amherst Sports. What are they about? What are you seeing?
Yeah, sure. Another stock at all-time highs was an IPO back in early 2024. It's a portfolio of outdoor and performance brands, Arc'teryx, Salomon, and Wilson. And what we're seeing is differentiation in the marketplace, innovation, a direct-to-consumer-led strategy that's driving tremendous global growth, growth that we think consensus is underestimating. They also will have an investor day in September for Arc'teryx. We think they're going to lay out pretty above consensus long-term targets for both growth and profitability for the Arc'teryx brand, which is the key driver of the overall portfolio right now. So we think they're very well positioned in a tariff environment. Again, their growth is very global. We think there's clear drivers of gross margin expansion and top line growth in the next 3 years that consensus is underestimating.
If an investor hears this, does their homework on the name, what do they need to be aware of in terms of risk?
Yeah, their China exposure is quite high, particularly with the Arc'teryx and Salomon brands. And quite a bit of their growth has been fueled by China store growth the last several quarters. But again, this is a premium-led strategy in categories that are resonating with consumers globally. And we continue to think this is very well positioned versus peers in their respective categories. I think you're going to see very strong results when they report in a couple of weeks.
All right, the final name on the list here, we're well acquainted with them in Canada, Lululemon. What are your thoughts on this one?
Yeah, a tremendous Canadian brand that is going through some pains right now in the U.S. in particular in terms of growth. The competitive environment's gotten much tougher. The stock is now valued at roughly the same valuation multiples as it was during the global financial crisis in 2008 and 2009. The stock has been a big laggard versus peers. And they're clearly struggling right now with traffic and demand. I think part of that is the competitive environment, part of it's the macro, part of it's just the fact that they drove such tremendous sales growth in North America, both the U.S. and Canada, really since COVID. We need to see some improved innovation, improved marketing, improved execution in the marketplace for them to get their top line moving in North America in the right direction again. China and the rest of the world has been pretty strong. It did slow when they reported their first quarter results, but we think it'll reaccelerate into Q2. And again, you're looking at one of the cheaper valuation multiples in the global retail sector at this point.